The financial crisis has had a dramatically positive effect on boards in the sense that it's frightened them. It's properly frightened them. I'm John Gieve. I was at the Bank of England as Deputy Governor and Permanent Secretary in Whitehall. Every board that I'm involved in is very absorbed with risk assessment at the moment. So they're all trying to assess what is the risk in this business, have we got a grip on it, do we know what we do if something went wrong. But I feel that most of the boards I'm on don't feel they've completely cracked this yet. Quite often you'll see boards sort of looking at the risk register saying, yeah, no, I think that's a good description of the risks, and moving straight on without getting to point B, which is, yeah, well, what are we going to do about them? I was in charge of publishing a report in the summer of 2007 assessing the risks in the financial system. And actually, we did spot most of the risks, but we didn't really believe that they could blow the whole system apart. We thought we were in for a correction, a shower, not a sort of hurricane. And we hadn't, we hadn't had the courage of our convictions. If you'd said, even in the summer of 2008, we're going to nationalise two of our major banks and we're going to have a deficit of 100 billion next year, people would have said, that's sort of way out in the tail. We'd accepted, I think, too readily the reassurance of the industry, but also of other commentators that, that they can handle it. The job of a board is to sort of support and challenge. Everyone knows that, and they all know they're supposed to be challenging. I think people underestimate the sort of social pressures to actually err on the side of support. And so I think just that willingness to be the grit in the oyster, actually to ask the awkward question and make sure that it's followed through, is quite difficult. Certainly in 2006-07, when I joined the Bank of England, I found there was a very strong consensus, if you like, and not just in the Bank of England, but across all the central banks and most governments and most economics professors and most market participants, that the development of derivative products had allowed a degree of hedging of risk and so on, which had made it easier to manage risks and allocate them in the right place. Now, as it turned out, that wasn't true. And the spreading of risk actually also spread the danger. We had a group of similarly trained professionals, and they'd got common blinkers. I thought we should have had, and I think this is true of most big companies, that you should actually set up or commission a group of people to go away, the red team if you like, to go away and produce a short presentation on what big mistakes might you be making, what really life-threatening mistakes might you be making. That will generate in any board a really valuable discussion. And I think that's quite common actually in sort of military preparations and scenario planning. It's much less common in boardrooms. I think just relying on people asking challenging questions is probably not enough. My feeling is that the big danger is they don't think radically enough. In the next 5 years, the euro area could break up. We could have another war in Eastern Europe. We could leave the EU. These are the known unknowns. Everyone knows about those. Each of those is an economy, a massive political and economic bomb, and yet those are all the ones we know about, let alone all the ones we don't know about. So appreciating the range of uncertainty and making sure that you take the time and you set in place a process to really look at what might go wrong. The world is a lot less certain than it seems, a lot less certain.